Good evening and welcome to SAIS Europe. This is the faculty research seminar that we have, and I'm very happy to welcome this evening the newest associate that we have in our research community, Mr. John Cummings. John is right now engaged in, I think, what must be one of the most important challenges that we face, which is not what he's going to talk about this evening. And that challenge is to marshal financial resources to transform our cities into sustainable energy use, high digital content, and useful long-term productive assets for our economies. He's been doing that for legal in general, where he's been a non-executive director since 2017. But we're actually brought John here to talk about what he did before he went to legal in general, and to use that experience to give us some insight on what we should be doing as financial economies to stabilize ourselves in the context of this novel coronavirus pandemic. John was educated at Oxford, where he got his BA and his MA in modern history. He then went into the banking world. He's been a treasurer at MBNA. He was group treasurer at Standard & Life. And then he went on to be group treasurer in Royal Bank of Scotland for the group of Royal Bank in Scotland. And he went Royal Bank of Scotland, and he went there in 2007, which is right before the last crisis really began to tear up the financial industry in the United Kingdom. And he stayed all the way until 2016, riding what must have been a veritable hurricane in terms of trying to stabilize both his institution and participated in the stabilization of the wider British financial economy. So we've asked John to come and give us some insights on what lessons he learned during the last crisis and that we can apply to the crisis we face today. John, it's a great pleasure. Well, first, it's a great honor to have you in our community and a great pleasure to have you here. Thank you so much for coming.
Thank you for having me. It's very kind.
Look, John, I want to start with your experience during the last crisis. Can you tell us that story quickly about how you came to be group treasurer at RBS at that particular moment in time? And you're welcome to go back as far as you want to Oxford if you want, but I just want to hear how you became the person on the spot at what must have been the worst spot to be at that particular moment.
Yes, well, my stock advice after my experience is whenever you say in a job interview, you really like a big challenge, you should be careful what you wish for, because that's what I got at RBS. So to do a quick fast forward from Oxford. So people always ask, how could I being a treasurer in a very focused asset and liability management profession with a history degree? Well, it taught me how to think, and my biggest focus there was always on economic history and the Great Depression and the New Deal, and in that type of space. And that's what people always say, that's why I'm so cheerful. But I then went into Citibank graduate program, and then I left there to go to a small institution to do money market sales. So that's for my first market job. And then ironically, it was losing my job when the firm shut down in 1991. I learned a lot about myself as well as what skills I needed to go forward. So then I went to a small, what you call a savings and loan, a building society, Yorkshire Building Society, and that's when I got serious. So I did an MBA at night school for 3 years. And then my first lucky job, as you mentioned, I was made treasurer of MBNA when I was 32. So I actually set up a treasury from scratch, a lot of focus on systems, people, funding, policies, risk. So I had the experience of doing it literally from a desk and a phone. And that was amazingly great experience. And I learned about capital markets and securitization. And then I got hired to be treasurer of a major insurance company called Standard Life at 35. And I was on the board of the bank there, and they set up a bank, and I helped set the bank up as well. And I ended up having, again, a build up from three junior dealers to 45 people. And I was finance director of the bank at the end, as well as, and I was about to be made CFO of the life business, which for a non-accountant, non-actuary is quite unusual. And then I continued to do all the way through, would keep doing, is why I was so attracted to John Hopkins, is learning all the time. So I did corporate finance program at LBS, INSEAD, Cranfield, Chicago, etc. And so I always kind of felt I had to have those if I didn't keep learning, then I'd sort of atrophy. So, but because I got to a treasurer job quite young, so when it came for RBS, I was 45, which again is very young to be treasurer of such a major group. It was the largest bank in the world when I was hired, and they needed someone to put the two treasuries of ABN AMRO and RBS together and basically do a huge amount of change. The predecessors, to be honest, had the kind of pressure to the. One of my predecessors committed suicide. They didn't tell me that till actually I joined. And then my then predecessor, he left in August 07. So there was a lot of crisis management, which I'd had some experience of at Standard Life. We went from AAA to single A in 14 months on the ratings. Great. Ratings were a good indicator of how much trouble you're in. But when I joined the week after they bought ABN AMRO, and basically they became the biggest bank in the world. So their wholesale funding requirement was just under 300 billion pounds, which is, you know, proper money to anyone in dollars as well as sterling. And on top of that, we had off-balance sheet contingent liabilities of 60 billion pounds, which was a thing called conduits, which are short-term funding vehicles, which are never supposed to come on the balance sheet of a bank. So, but when they do, it just adds to the problem. So in total, I had to find every month 30 billion pounds. So that's why I ended up getting to places like Baku and Azerbaijan and the Middle East a lot. And I went to China 22 times over the 10 years. So the markets had problems in 07, and everyone regards the start of the GFC as BNP closing their money market funds because they weren't able to value the asset-backed securities. And then all the way through 08, you had sort of events such as March 08 Bear Stearns, and then you had various things leading up to, but the really catalytic event was obviously the failure of Lehman Brothers. And that one event, which I think because of where and I've read a huge amount of books on this, and I know there's a reading list, and happy to share those ideas, but that was a catalytic event. So we raised 12 billion pounds of equity in April 2008. We thought with that equity raise and selling some of our businesses, we would be well shot, because the policy of RBS before was to always have, you know, the core equity tier one was around about 4-5%. But, you know, you'd build it up a bit and then you buy something new and then it would go down and up. It was like a shark's teeth. And core equity tier one wasn't seen as the importance it is now, when now everyone needs to be in double digits. So instead of being 4%, you've got to have 14% or 12%. And the core equity is basically your whole capital, which you have to defend against when asset prices drop. So the problem with Lehman's and all the banks going into 2008 were over leveraged and undercapitalized and too much wholesale funding. So when you're trying to borrow 30 billion pounds a month, the example I always use is, I know many people on the call like horse racing, but if you've got a horse running around a track at Ascot or any of the big race tracks and it breaks a leg, the vet normally kills it because it can't go any further. And so when you don't have access to wholesale funding at that level, you don't survive very long. So effectively, in the UK banking system, there wasn't enough focus on liquidity. And Basel didn't ask about liquidity either, because we just assumed banks would have that liquidity as a very ongoing functioning interbank market. Well, that kind of stopped. And after Lehman's, basically no one trusted each other. So people stopped lending to each other. And that's when that exacerbated the crisis. And that's when eventually I was the one who made the phone call to the Bank of England for 48 billion pounds worth of emergency facilities.
Now, I mean, as I listen to this story, John, I'm trying to imagine what it must have been like in the room at the time, right? I mean, my sense is that everything must have been so unfamiliar, and that it was a lot of experimenting or learning by doing. And in one of our previous conversations, you mentioned that no bank in England had gone bust since before the Great Depression in the 1930s. So I guess, do you think it was that lack of experience with bank failure?
Well, so it's interesting. So there's a great book called Saving the City by Richard Roberts, who's a wonderful economic historian. Unfortunately, he died young. But the scheme that was used at the start of World War I in 1914 was very, very similar. And the Bank of England used the same scheme in April 2008 called the Special Liquidity Scheme, where you could pledge mortgages and get UK Treasury bills and use that for liquidity. There would be no major bank failures. There'd been some secondary bank failures in 1974, but there would be no major bank failures of UK banks at all in the 1930s. And you've got to go back to 1825, and there's another book there by a guy called John Turner, who's a professor at Belfast, where you effectively can see where all the general banking market had a systemic issue like we did in 2008. So 1970s, you had some bank failures in 74. But these were all small banks. These weren't not the major core clearing banks. And again, you had Bearing's failure and you had BCCI, and these had knock-on impacts, but they were localized to smaller banks. The major UK banks walked through the 1930s because they all had a lot of liquidity, which they invested in gilts. And again, when you get into some of the minutiae of some of the issues I faced, very often people have short memories. It's one of the reasons I want to do this type of work with you and John Hopkins is if I can pass these lessons on, that whoever ends up in senior positions in other institutions, you can never, you really don't want to go through what I went through, to be honest, because there were sort of quite large human impacts as well, and not just in terms of people losing their jobs. Financial crises cause far more damage to an economy than a normal downturn of a business recession. And that has been the same with the GFC. So we had a situation where we were heavily reliant on wholesale funding. We'd raised capital, but it obviously wasn't found to be enough. Then the government came in and recapitalized all the banks over that weekend after I'd gone for the facilities. And effectively, the government guarantees on bank deposits stopped the run on the Northern Rock was nationalized in February 2008. So all the way through 2008, leading up to Lehman's, there was just poor events in the subprime mortgage market. Bernanke at the very start of the subprime mortgage view said this is a manageable crisis, and everyone underestimated from effectively the public sector, from the regulators, from the central banks, and from the investors, that it literally just eviscerated in terms of confidence, and people stopped trading with each other. There were a lot of margin calls. AIG's rescue was just as important as Lehman's non-rescue, because that would have actually created some very large investment banks in the US and globally as well.
So in that very initial phase, John, what do you think the policymakers got right, and what do you think they got wrong about how they tried to stabilize the financial economy?
Well, I think they did try and get sort of unfreeze some of the markets in the UK and other places, and they did do. It's very interesting. There's a really great slide graph in the crash book by Adam Tooze, which shows you how much of the US Federal Reserve money was used by overseas banks. Because there was a dollar funding shortage. If you're always borrowing dollars, because that's the biggest, deepest liquid market, and then you've got to find dollars to pay back, and people are not wanting to lend dollars in outside of their own, because there's a kind of nationalism when it comes to these sort of events where people focus and say, well, I can lend to BNP in France or something because they're French and I know them, but I don't know some of the overseas banks. So there's kind of and it was a Federal Reserve's really focused, along with the other big central banks, to turn the spigot on after Lehman's. Before Lehman's, there was a lot of good, modest stuff, but it was the Lehman's event which actually just catapulted it to a different level, and then everyone had to be recapitalized. And then you got into, a couple of years after that, you got into the whole Euro crisis, where, I was directly responsible for funding Ulster Bank, which was the third largest bank in Ireland. So when the Irish government guaranteed every single bank in Ireland, they didn't guarantee the one beginning with U. And that was done at 5:30 in the morning. And that meant, obviously, if you're the outlier bank, then, so the amount of funding we took to Ulster Bank for equity and funding took nearly a third of our rescue. We were rescued for £45 billion of government equity into our capital base in 2 tranches. A third of that went to Ireland. The money they lost in Ireland was basically on property, the subprime, and the mortgage explosion, which then resulted in a boom and a bust. And so very poor commercial and retail mortgage lending and some fraud basically caused all the Irish banks having to be recapitalized.
Now, if I understood what you said correctly, the Irish government's efforts to stabilize its own banking system actually provoked a run on the Ulster Bank?
Yeah, because effectively then they realized it was only just us supporting them, but they took the view, which never you turned out to be correct, that Royal Bank of Scotland, we can't let a subsidiary go under. So they effectively got the Irish banking system were helped by UK taxpayers. And that's not a controversial comment, it's just fact. So, but if you got subsidiaries around the world, when we put ABN AMRO and RBS together, we were in 53 countries. When I left 10 years later, we were in 12. But when you have lots of overseas subsidiaries, you can't let a subsidiary, it's not been tried, other people have tried it, we didn't want to. You can't let something go under in one country because a ripple effect in a modern globalized communication world, it would immediately come back to you in the center saying, if you're not willing to support a subsidiary in Ireland or in wherever, then you've got an issue.
So if you were operating in all those countries, your funding requirements were not just in sterling, right? You had
oh yes, that's the issue. The sterling market wasn't big enough to fund a bank of that size. So the size of our bank was the size of the GDP of the United Kingdom. So that just puts it in perspective. I mean, the numbers are very large, and people are always sort of surprised. I'm quite calm about it, but I'm a historian, so there's always someone who's had a very tougher time than I would ever have. So, and you work the problem and you focus on the stuff you can fix, and other things. It's like with the pandemic, you work on what you can do to fix things and what you can do, but other broader macro issues. I think it's interesting with social media and other events that people now all the stuff comes into your phone, but a lot of the stuff, if you can't control it, you don't sweat it. That's how I manage my workload.
So just so that I can keep track of this, uncoordinated liability support, so deposit insurance, that was a failure, right? I mean, you wanted that to be coordinated if it was going to be done at all.
It would. I mean, I'm not being too critical. I mean, they were coordinated, but it just post Lehman's, the scale of it, that's when everyone geared up. And before then, there was good support in terms of special liquidity scheme. But the Mervyn King said about moral hazard for Northern Rock, and then we ended up nationalizing Northern Rock. So there were things that could have potentially been handled better. But then when the actual Lehman's thing hit, and all of a sudden it became really system critical, then all the Fed and the Bank of England and all the central banks and everyone and the governments stepped up to do large amounts of equity injection guarantees and save the system, effectively nationalize the banking system. In Mervyn King's book Alchemy, that's what he talks about in terms of, it's ironic that the people who are the most free market adherents, the ones who lobbied hard to remove Glass-Steagall, were the ones who all got rescued by taxpayers. And I always told my colleagues who are upset about bonuses or whatever, I'd say the only reason we're all here is that the UK taxpayer bailed out all the UK banks except Barclays, and they got the money from the Middle East. And that ended up with a fraud trial, only just recently completed. And the average income in the United Kingdom is about £27,000. So all those people paid to keep me in a job, and I never forgot that.
Now, in this context, I guess that we all know that at the end of the story, RBS is safe. But how long did it take for you to stabilize that balance sheet, and how many injections of government support?
There were two major injections of the 45 billion, and then over time, for example, we created about £6-7 billion of equity just in treasury in terms of buying back bonds and reissuing them, interest rate positioning available for sale. And that effectively all went into Ireland. So Ireland, Ulster Bank took £14 billion of equity, was recapitalized twice. So, but you were stable, say you could say by 2010, we were very heavily owned, state-owned bank along with Lloyd's, and most people credit-wise were happy with that risk. But then you had the European crisis come along because the events in some of the smaller countries, the whole Eurozone, where people thought, you buy a Greek bond, it's as good as a German bond, that all came under pressure. Because don't forget, quite a lot of these markets effectively shut. The fan brief market, which is now still quoted as a very strong market, they shut. The ABS markets were shut for years. And so that brought pressure on, by saving the banking system, some of the Portugal, Spain. I think I read in statistic that Spanish housing market in the boom before 2007, they built more houses than France and Germany combined, and they're a third of the population. So there was a lot of mortgage growth and housing boom, which went bust. And then Portugal, Ireland, Greece, Spain, all those countries, they had their own issues. So that's when the EU became. I mean, one stage, Trichet actually put interest rates up, which was bizarre in this environment. And it was only when you got Draghi coming in saying that the bazooka will do anything. But so the Eurozone crisis did prolong matters. And obviously we had a Eurozone bank with ABN AMRO and Ulster Bank. So we're very aware of the Eurozone issues where people got the credit spreads between Ireland and Italy and the Bund were just, obviously now you've got negative interest rates in Germany, for example.
And how much of a difference did it make that your main institution was obviously in the United Kingdom, which had its own currency? Did having its own currency make it easier for the British government to
yes,
to
absolutely,
stabilize you guys?
because otherwise you'd have just be doing what the ECB did. And that it was that independent financial, fiscal policies. I wouldn't say it led to Brexit. A lot of other issues led to Brexit, but and I ran the preparations for Brexit or RBS for 18 months, as I did for Scottish independence, for example. But the ability for the UK to have its own currency, manage its own, it slashed interest rates very aggressively, whereas Trichet, for example, increased interest rates just in the middle of some of that Eurozone crisis.
Do you think in that context that the lessons that you learned in Britain about stabilizing the financial economy are very different from the lessons that we learned on the continent in Europe?
No, they're very similar, because the lessons still are, you have to be very aggressive in quantitative easing to unlock bond markets. You have to be able to get sovereign nations to access bond markets. And the ECB just took a while to get there compared to, and then obviously the pandemic has totally changed what everyone are doing in terms of, Keynesianism has come back with a vengeance in terms of public sector, counter-cyclical structural spending. But I do think that the issue you got is the Eurozone, the euro currency fits northern parts of Europe better than it does some of the pressures you have in Italy, for example. Because you've had that low growth now in Italy for extended periods. The biggest worry, in the 1970s, the biggest worry central banks always had, and you had Volcker's Saturday Night Special, was effectively rampant inflation. Now the concern everyone has got is deflation, because if you get into deflation like Japan, for example, it can be multi-decades, as you know.
Now, I guess that sort of brings us up more toward where we are right now. Your bank finally did get stabilized. The financial economy seemed to have gotten stabilized, but did the experience of the last crisis prepare us to respond better to the crisis that we
Yes,
faced?
absolutely, because though you had that dash for cash in March of last year, where there was a liquidity surge, and there's some slides at the end of my slide presentation, shows that because of the increase in simplicity and central clearing counterparties, a lot of the credit risk has been transferred. Plus, all the banks have got much, almost 7 times the amount of liquidity they had in 2007 and 8. So that, when I left, I went from 360 billion pounds of liquidity, wholesale funding required, down to 75 billion pounds when I left 10 years later. So that, and our liquidity portfolio was double the size of our wholesale funding. There's a very simple metric called the loan deposit ratio. If you're 100% above 100%, you've got more loans than deposits. So then if there's a problem in the wholesale markets, you potentially have a problem. Whereas now, most UK banks, the big ones are actually low, they have got more deposits than loans. And obviously in the pandemic, in the UK market, there's been over 120 billion pounds saved in the past year with personal and customer savings, because they can't go out and spend it. That's where the UK bank economist, a guy called Andy Haldane, is thinking there will be quite a big, he talks about a coiled spring, a spring bouncing up as people go out and spend the forced savings, if they've been lucky enough to be in jobs where they can save. So that asset liability profile of UK banks is totally different. Before you went into the crisis, where, with the exception of HSBC, every large UK bank had a loan deposit ratio. We had 156% for our one. Is much higher, and you're very reliant on wholesale funding, and with 2 big banks, and you're too big to fail. And the resolution changes the Bank of England have made, and all the central banks have made on liquidity, capital, senior management responsibility, where you actually you can have your bonus clause back. You can go to jail for doing some of this stuff now in terms of managing a bank recklessly. Then that's all to the good for the financial stability of the whole system, because the problem is that the banks, when they go wrong, have much more wider impacts on the underlying economy, and it takes much longer to recover from a financial crisis than a normal business cycle, recession, and then expansion.
Now, in the context of this current crisis, we're getting a drumbeat of news about the buildup of public debt, but also about the deterioration on bank balance sheets and the buildup of non-performing assets. What do you see as the biggest risks that we have to deal with, and what should we be doing to prepare for them?
Well, I mean, there are three choices when government gets too large, and I don't think it is too large at the moment, because either central banks buy it or investors are looking for yield and that they buy it. But you can live with very high government to GDP ratios. However, you do have to have growth. If you can't have growth, that's when if you don't get inflation, then so in the UK, for example, interest rates didn't move for 7 years in the 1930s. It's 2.5% all the way through. It moved the day of the World War II started. So low rates for longer are okay for bondholders, but at some stage you have to, for a very large amount of government debt, you either have to extend it, you have to start repaying it, or you let inflation eat away at it. So at the moment, it's not the right time, as I read in the papers and research, that no one's suggesting taxes will go up right now in the UK, but they will go up to pay off this debt. And then it will just be how that tax and that fiscal burden is shared. And then you've also got the fact that if you got good growth, you can actually grow your way out of the problem. Your issue is, it always comes back to demographics. If you look at the Italian bond market, which is the fourth largest in the world, then the Italian population and demographics are not growing, then that's where you can get into some issues. And you've obviously got the 1 trillion euros of target 2 balances between the ECB system, between the Italian liabilities and the German depositors.
Now, you mentioned this point about low yields on bonds, and it reminded me of where we started our conversation with the work you're doing right now. Do you think that there are risks associated with the fact that insurance companies, pension companies, and the like are not able to find the kinds of assets that they need over the long term to generate the returns they need to meet their contingent liabilities?
Yeah, so effectively, people are, one of the reasons I was hired and my insurance company, along with a lot of other insurance companies, Aviva, Henderson's, Scottish Widows, everyone is looking at direct investments because you can create long-term yields, and we need 15, 20-year yields. If you create real assets, whether it's infrastructure, whether it's built, sorry, it's my dog, apologies, buildings, wind farms, and you create a long-term income to pay. In the 1920s and 30s, many insurance companies owned houses, and they're going back to that model because you owned houses for rent. You took the rent, you paid the annuities, and the actuaries hoped everyone would die on time, because that's kind of what you're supposed to do. So that looking for direct investments, they're agreeing with me. So looking for direct investments just gives you a different sense, because if you've got a 30-year bond only paying 1%, and you've got a 30-year liability for your pension, you need to find something with some sort of inflation uplift, and 2, a high yield. But it doesn't have to be 10%, because 10% you have to take real speculative risk, for example, in property to make that risk. And by definition, not all returns come out. And you've obviously, that's why I've seen with low rates, if people have been sucked into the equity markets, and they've bounced really aggressively. And it's interesting. I've never tried to predict things. I know what I can safely, when, for example, with Brexit, we hedged our dollar liabilities because I said it's a 1 in 2 chance of this happening. And if it does happen, sterling drops. So from an asset liability risk management perspective, we hedged our sterling, our dollar fines, because they were a large amount. So, but for predicting where the equity market goes is for a job for brighter people than me. And then you get into things though where you've had that whole speculation in some of the video game stocks, etc. I mean, Bitcoin was down at $3,000 4 or 5 years ago. It's now at $50,000. That smells and looks like a bubble, but bubbles can last a lot longer than people can remain solvent if they're betting against it.
As this crisis drags on, John, the question that many people are asking is whether this is going to affect a structural change in the economy. How confident are you that you can pick the real assets that are not going to be affected by that change? And here I'm thinking particularly about commercial real estate, which seems like it may go through a significant transformation.
Yeah. So on commercial real estate, we tend to partner. We partner with local authorities. We partner with universities. We partner with people who've gone to, Oxford University has done a JV. They've been going for 750 years. So we partner with people who've got long, and I know Bologna University is a very, very old university. So you partner with long-term, and you try and create product which is useful, not just for the immediate short term. And yes, working patterns will change. Most people are saying, there was a Barclays report on commercial property said roughly 20% of all commercial property will probably be less required. You've all got the impact of the retail market happening now across all of Europe, and you've already started to see bank mergers happening because there are too many branches, for example. So there's going to be changes, and change is always constant. So I think you've got to just be careful what is your credit risk for the long term, and you have to manage to have the flexible office space, for example. And if we're going to a hybrid model, then at the same time, digital investments has been very impressive because everyone's streaming, and you just have to look at Disney's massive increase in subscriptions. And for that, you need digital capacity and data centers. And renewables, everyone has been focused now on renewables, and that's not going away as an issue.
Now, I want to get some questions from our audience, but before I do, I want to ask you a couple of sort of more personal questions. And for those of you in the audience, if you want to ask questions, I would recommend that you use the Q&A button, which is the one in the middle of your screen at the bottom. So if you have your mouse over the screen, you'll see a bottom button bar light up, and then you can access the Q&A. Please don't use the chat though, because we're only going to monitor the Q&A to get this done. John, the personal question is really about what it must have been like to work through that last crisis. You've mentioned already that your predecessor, one of your predecessors, had committed suicide. The personal toll of that crisis must have been horrible, particularly given the way banking was viewed by the outside as somehow responsible for the events as they unfolded. Well,
to be fair, we were, to be honest, but also, there were other people who made mistakes as well. The politicians did. I mean, Sir Fred Goodwin, who I knew him for a year before he left the company. He got knighted and was made Bank of the Year 3 years before he became a social outcast. And at that time, the financial service company sector paid something like 15-20% of all taxes. So everyone's saying, this is just let the thing keep going. And then there were people who warned about it in the housing boom, and they were accused of talking down the country. But a lot of these events and issues, we did it to ourselves. And if you believe in market forces, then that's we were bailed out. So I mean, there were a lot of people who lost jobs. I met 45 pensioners from Royal Bank of Scotland. I was sent to Aberdeen in 2010 to explain why they lost their life savings, and that was a very brutal meeting because they were very loyal employees who'd been there. They'd never sold an RBS shirt. They lost money. I lost money, but I had 10 years to earn it back, or 15 years to earn it back. They had none, and that was a very hard meeting. And I was sent because I joined after the event, so I was sort of seen as I was there to clean it up and fix it. But there was a lot of grief that caused a lot of personal anguish and pain to a great many people, and we eventually did a rights issue settlement, for example. But there were behaviors which were really awful and got caught, and some got caught and some didn't. But that's why you've now got the new regulation and the ability for the Bank of England to sanction people and to not just criminal but civil penalties as well, and ban you from working ever again. So I do know of 2 other people who committed suicide after the crash, and that again is something some people do, and it's incredibly sad. But I was lucky. I went through the process and through the crisis, and I was lucky enough to be in a really interesting place to work, and because I had a background which kind of taught me some of those perspectives, I was able to see it for what it was. And one last question before I open this up.
What lessons do you think we should learn from the present crisis, right? I mean, is there something that we could add to the portfolio of insights that we've been accumulating since the last crisis took place?
I think we just have to, everyone does horizon scanning. I'm chair of a risk committee for Lloyds Bank Corporate Markets, which is a wholesale bank for Lloyds. And in wholesale scanning, it's ironic that the two countries who actually funded the Centre for Epidemic Prevention in Norway were the UK and the Norwegian government. And even funding a Centre for Epidemic Prevention, and I'm on the monthly newsletter and I read it because I was interested in vaccines before this pandemic. We were due a large pandemic, but no one properly did the preparation. There's a great expression from Louis Pasteur: fortune favors the prepared mind in the field of scientific observation. It's always shortened to fortune favors the prepared mind. No one expected that a pandemic starting in Wuhan could cause such global mayhem so quickly. But if you go back to 1918, we had far higher mortality rates. Ebola is something which we should be really grateful never gets out of Africa at the moment. And your really big issue is, I'm sorry, I read some really interesting stuff, but you've now got antimicrobial resistance drugs. I think TB was a massive killer in the 19th and 20th century. It got cured after World War II. My grandfather died of it. And it's now coming back with strains which can't be treated with antibiotics. So that's a really big long-term structural issue in terms of that is a kind of public health issue. And the good thing about this pandemic, it will teach people to invest in care, but also you have to look, health is about income and it's about inequality. And the reason we've had, one of the reasons, not all, but one of the reasons is you're more an equal society, then you have these sort of variations in health outcomes, and that's something will be addressed, I think, as we build back from this pandemic. But it just goes to show you can actually do a lot of preparation. We can do the wrong preparation for the wrong virus, and you all scramble to buy vaccines.
Well, John, I can't thank you enough for this. This is incredibly helpful, and I know my students, both in my risk course and in my European financial markets course, benefited immensely. I've got some questions.
Great.
In the question and answer. I hope you won't mind if I turn to them now. The first comes from Thomas Rave, and his question is: we went through a period of sort of deconsolidation, shrinking of these banks that took place after the last crisis, but now it seems as though there's a lot of encouragement for a reconsolidation of the financial system. Do you worry at all that we're going to build up banks that are too big to fail and indeed too big to save, given the size of the national economies within which they operate?
Well, I think all the banks, all the countries now are looking for national champions that can. But then you have the regulatory policies on capital. At the end of the day, if you've got 15% of capital, you're in a far safer place than 4% when we bought ABN AMRO. And that not going to happen again. Now you can't go below double figures for a major systemically important bank. So there's far more capital. It's real capital. It's not subordinated debt. It's core equity tier one. That's your first badge. That's your first building block. If you look at the slides, you can see some of the building blocks, and that's from the Bank of England's own slideshow. So I'll just kind of put that in as. So you've got liquidity regulations. Now you need a liquidity coverage ratio. You need to be able to survive at least the first month, but everyone normally has 3 months of liquidity. And again, when you look at loan deposit ratios, if you've got more deposits and loans, you need a very substantial retail run like a Northern Rock, as well as, and don't forget, in the age of the internet now, it's much easier to take your money out of banks than it ever has been in terms of people's behaviors. Whereas in the past, when that Northern Rock queue, and I kept a picture of that in my room, and people say, why have you got a picture of Northern Rock people queuing outside? Because it's my job to make sure that doesn't happen to this bank. Now we had a wholesale run. So when I made that phone call, it's public information. My 0 to 5 day funding gap was £100 billion. So that's how much I had to find in 5 days. And that's when I thought I needed to get some emergency assistance. So, and that was kept quiet for 2 years, but then it was released. So interesting enough, some of the new Dodd-Frank regulations make that incredibly impossible for the Federal Reserve to give one bank unofficial or kind of secret help. It's now got to be published. And that is actually a very different thing. So I think you need consolidation because weaker banks will have loan losses. But again, it comes back to banks are mirrors of society and their underlying economy. And as you go more digital, you don't need as many branches. So 10 years ago, there were 1,400 bank branches in each of the big 5 UK banks. They're now down to about 12. Sorry, there were 2,000 10 years ago. There's now 1,400, and now it's going down to 700 each because people just don't go into banks. You will go on the online and do it. And the online growth of Amazon and everyone else means your shops have got an issue, but also, banks, you get your card and you pay your card and you don't go in a bank to do stuff. So you don't need that type of model anymore. But digital risk is actually just as important, or even more important now than physical risk. So the digital and cyber risks that banks face all the time from fraudsters and from government entities wanting to. If you're interested, there's a very good book called Perfect Weapon, David Sanger, about cyber capacities of all the different countries. Estonia was shut down as a country by the KGB in 2007, all the way from utilities, banks, ATMs. Estonia has always been pushing for at the envelope being a digital economy, and then they just all got shut down. And that happens more and more. And it's not just climate is a threat, which we haven't talked about. Climate is a really interesting threat for everyone, but that type of risk. So consolidation, getting enough capital, but to expand, the rules will should stop you doing silly expansion in terms of liquidity, funding, capital, which are the 3 metrics you'd be as a bedrock to manage.
And this feeds nicely into a question that Nicola Daniel has, which is, it's not just about technology and it's not just about banking, but it's also about politics. What do you think is going to be the impact of Brexit on banking in the UK and on the status of the City of London, for example?
Well, it's going to be hard because the agreement doesn't cover financial services. And that's still to be decided with the European Union. And you've already seen there's more equity trading now in Amsterdam, which was not seen, as in European equity trading in Amsterdam is in London. And that's just literally the most recent number out. Now, a lot of that's digital anyway. So, but you over time, we will have to work harder to actually be relevant and continue to be relevant. But you've got 300+ years of financial innovation and growth and development, which has enabled us to meet customers' requirements, to meet trade flows. So though we lost our role post World War I, the US became the dominant currency. It's not a trick question. I always ask a lot of other senior bankers, do they know what sterling dollar was in 1918? And they kind of say, and they're amazed when I say it's 475. It's now 139. It's about 100 years of one-way traffic. We got up to 2 a bit in the mid-80s, and that was it. So I do think there are other options. But then if you look at fintech, the highest center for fintech outside of Silicon Valley is in London. So yes, there are going to be challenges in terms of some financial markets. The European market infrastructure is very controlled. But then you look at the growth of unicorns in IT, for example, and that's why Wirecard has been such an embarrassment to the German BaFin regulator and government, because they tried to protect it and it was based on almighty fraud. But then there weren't many big European IT successes. And so you've got to see whether if the new jobs are coming, then those, I'm not critical of Europe at all. I'm just saying there are some large issues for everyone in terms of the new economies and supporting digital technology, both in Europe and in the UK. And I hope post-Brexit we can still cooperate. It was a great shame to me to read about the Erasmus program stopping for European students from England and from the UK. And I thought that was a great shame, but we need to try and make sure we continue to have cooperative opportunities amongst leading universities.
And on a slightly different note, Semi Pasha has pointed out something that hadn't occurred to me. You talked about how long it took to recover from the last crisis. And Semi's question is, do you have any thoughts on whether some of what were introduced as temporary measures on liquidity requirements, loan loss provisions, capital standards, due to COVID. Do you have a sense in which they may become the new normal for an extended period? The banks are going to be given special treatment because the recovery is going to be slow?
They've had special liquidity regimes, so they've brought in cheaper funding, and they're people still wanting to lend because it's a not lending in through the cycle, which is what hurts people. But again, on loan losses, whether it's a government scheme or the bank's own loan losses, you have to recognise them, and where you don't, you get into issues where banking systems don't. You don't take the pain on the loan losses. And it comes back again to, if you've got strong capital ratios, you can afford to make the earnings and earn the income to cover some of those loan losses. But again, it depends on the sector. It's very heavily skewed towards sectors which have been really hit by pandemic: retail, hospitality, travel. I've not been abroad for 2 years. I can't remember the last time I've not been abroad in a year. Mind you, I was a gold card with British Airways, and I don't miss that at all. So, as I said, if you end up in Baku and Azerbaijan looking for money, you're on the hunt for it. So I don't miss the travel, but I do think some of those sectors will take time to recover. But then you've got a lot of resilience, and people, when they predict, it'll take an awful long time. Even in the 30s, in the Depression, there were parts of the UK had really quite very strong growth areas. It was just heavily localized in the north and in Scotland and Wales, in heavy industries like coal and steel, which all came back with a vengeance with war expansion.
Now, we've been talking about banking sort of with a particular eye to understanding it as an industry, but we haven't really been talking about the job of being a manager in an industry under duress. And Moritz Lütgerath had a really interesting question. What was it like to lead an organization that was under so much stress? And were there any lessons that you learned about leadership in the context of the last crisis that you hadn't expected going into it?
Well, this is going to sound slightly odd. I really enjoyed it. I thought it was an amazing opportunity to demonstrate what you're really good at. And part of it is taking people with you and had a lot of communication. And some people didn't want that stress, and some people did, but you brought in people to help you get the job done, and you would just always frank with them and honest with them in terms of where you're going and what you're trying to achieve, because people want clarity. And I've had to make people redundant and I always did it myself. If I brought someone in and I had to make them redundant in the end, I did it myself. And that's that. But then I've also worked really hard, because I've got a strong network to help people. I've now got 22 group treasurer alumni around the world, from the Middle East to Asia to the UK, etc. And because I did always care about, because having been unemployed myself and lost my job, I remember what it's like and how people treat you is very important. But it's honesty. It's actually being really frank where the situation is, and you kind of rise up to where some other people who, obviously all companies have hierarchies, but when you have a crisis, it's about content. It's not about style. And it's the content I had that I was able to deliver, and that's where people recognize. And though sometimes I was very blunt and direct in my delivery, it's because I needed to get stuff done, and sometimes you can't just wait for next week when, quite frankly, things are moving at a pace. And I really enjoyed it, to be honest. I thought it was kind of, I was the right guy in the right seat for a while. I also think knowing history, and obviously I'm a history geek, but knowing history puts things in perspective. And I remember one of my very senior colleagues telling me at the end of in 2009, he said, "You had a very good crisis. Everyone thought that, and you've done well." I said, "Well, how'd you cope with the stress?" I said, "Well, my grandfather's in the Merchant Navy. He was torpedoed twice, and he was bobbing in the Atlantic trying to get picked up. One time only one of the guy made it to the Azores. But in those days, the Merchant Navy, as soon as you were torpedoed, they stopped paying you because you're on holiday, you're not working. So the ship has sunk. So put that in perspective. My grandfather was bobbing the Atlantic trying to be picked up. I never met him, unfortunately. He died after the war of TB, as I said. But that puts things in perspective compared to the worst thing happened to me is senior people get rid of me and I'll be looking for a job like everyone else. So I think of that perspective, and it's having that robustness and also having compassion for people when you do have to give them bad news.
Well, I appreciate that sense of perspective and the idea that you get torpedoed and dropped into the Atlantic, and that is an excuse for your employer to stop paying you.
No, it's true. Everyone's shocked when I tell the story because it's such a, but that's capitalism. Welcome to the world. So, but that is, you in the Royal Navy, you got paid whatever the ship was sunk or not. But the Merchant Navy, they literally stopped paying you as soon as the ship was sunk. So I remember that story from my mother, and I've got a whole library of books, and I've always read about the Battle of the Atlantic and convoys because I've got his medals just up there. But you know, that's a tough day in the office. So I'm not going to complain about some of the stuff I went through in 2008, 9 or 2010, 12 with the Eurozone or Brexit or Scottish, you know, I've lived through a lot of financial market issues, and I've got next lecture I can show you. I got a confirmation when I lent money at 100% in 1992. When I've seen interest rates go from 100% down to 10 basis points. But you just got to have that perspective that, you know, there's always some, you know, people think the pandemic's bad. You know, I've read books on the plague. 1 in 3 people died, but then people who left, they got a pay rise because it actually started capitalism because people moved to the towns, feudalism started to break down, and then there's a shortage of labor. Wasn't much good for the people who were not around. But I mean, I just think you need to have, but I always suggested to all the people who are studying treasury, or they all think it's about, why would you read history? I said, well, it does prepare you for some pretty awful events. And at some stage in your career, whether it's disruption, digital disruption, or changes, or just bad luck, you will probably have to find yourself looking for another role, in which case you need to have that resilience and robustness about you and a sense of perspective.
So, John, it's interesting. You just said this word disruption, and we've got 2 questions in about different forms of disruption. One is Dante Fekete, who's asking about really the transition in Europe that they're trying to encourage to get people out of banks and into capital markets, going alongside the consolidation of capital markets through Euronext. So that's one kind of disruption. The other is brought up by Eliza Hunt, and it's about digital currencies. Do you see these disruptive influences changing the way banking is done?
Yeah, totally, absolutely. So there's no, sorry, I'm not trying to show off. I just read quite a lot of books on this stuff. So there's a great book, Why Aren't They Shouting, by let's find it, Bridges, I think. I'll send it afterwards to you. And basically, there's a company called XTX, X-Ray Tango X-Ray. You should Google them. And they're about 120 people and a dog. You always got to have a dog, and a bunch of machines. And they're now number 4 in global foreign exchange in the world. And they're not even a bank. Now, I've been having teams of people do foreign exchange for me for 20, 30 years. And it's always normally the same banks. They go up and down in sorry, I'm a big football fan, so I sometimes use Champions League analogies. For those who aren't football fans, I'm sorry. But, you know, there's always a sort of net, you know, either a Citi or a Deutsche or a Barclays or an RBS or BNP. There's UBS, all these good names. And this company is a foreign exchange price maker with better algos and trade. 95% of the FX market's algo trading now. 95%. So if you're not got good at your systems, and because they're a new company, they don't have the legacy systems, they're number 4 in the world. Now that's unheard of, and allegedly the most competitive market in the world in foreign exchange. And then you look at things like Revolut, which I use just for retail FX, because most banks get 1 or 2% spread on, it's one of the most profitable things in a bank is retail foreign exchange. That's why if you're overseas students, you go into the bank in Italy to get your euros, you'll see a lot of charges. Whereas if you use Revolut, there'll be a lot less charges. So again, that disruption will come through. And on capital markets, you've still got to have that fundamentally good credit to be able to get the bonds or equities issued onto the capital markets. So I think disruption is here to stay. You know, some of these jobs weren't even in existence 5 or 10 years ago. Bond markets are about 55, 60% digital now. Then you look at, there's a really good thing called exponential view and the ARC, which I can send to you and you can forward on. You have to register, but some of the AI in Bloomberg, when they publish the annual results, the little Barclays were out today, all the bank results, all the companies' results on Bloomberg are all written by a machine. As soon as they come out, they just get scanned and it's just put out, and commentary. And then there's more thematic, deeper commentary. So AI will definitely disrupt quite a lot of the analytics, and the legal industry is another example. So there's some interesting stuff here in terms of disruption. So my advice to everyone is just, as you finish your qualifications and look for roles, you just have to be really flexible in terms of where you go into, and just be ready to constantly trying to learn. I'm just always interested in, I've been lucky, I've been really lucky in my career, and I've had some bad luck as well, but I've been really lucky that I was able to get into positions where I could, obviously help others and coach others as well, but just learn. And when you learn, and don't be afraid ever to ask a really dumb question like, where's the money going to come from? And that's sort of some of those really dumb questions that people had asked them earlier. Some of the major banking mistakes in the past wouldn't have happened. And when I read about, my wife says, why do you read all this terrible stuff? This is, well, you learned from these mistakes. And the Titanic, everyone knows about the Titanic, but the accountants stopped them having all the boats to take them off because they were saving money because it wasn't going to sink. So you have to, and that's a true story. So if you Google the Titanic risk management, there's 180, I've actually read it, slides on from a Canadian engineer when the film came out to talk about timing. Then he was also in demand because even DiCaprio didn't survive it. So, but that decision by the cost accountants to cut back on the davits could hold 4 lifeboats, they made only 2 because the rule said you didn't need to have a lifeboat for every seat for every person on the ship. Now after the Titanic, they kind of do. So it's just those assumptions you need to question the whole time. And then when I had my colleagues talking about Brexit, I said, well, it could happen. And I go back to North of England a lot, and a lot of people didn't want Brexit. And I said, well, you can't bet it's not going to happen just because we're all in London and we don't want it to happen. You need to manage your risk to make sure if it does happen, you've hedged your downside.
So I think we've got a last question from Nick Steinwand, unless one of our audience wants to chip in something else. And Nick's question goes like this, John. It's given all this disruption, what do you see as the employment outlook in the financial sector? Do you think that everybody is going to be replaced by 12 guys in a computer, or?
No, I mean, I'm just giving one example of a very successful entry, but there are lots of other ones which are not successful. But I do think whatever you do, if you want a career in financial services, it's still a great sector to be in, but you just got to be really flexible and make sure you don't pigeonhole yourself and just constantly learn. I mean, and if you climate now is really large in all financial services, and climate will never go away as an issue until we can try to fix it. And that's a great place to work. So, but I think it comes back to resilience. People have been predicting robots since the Luddites in 1812 that they were going to be replaced, but there've always been new industries to come along and to work, and you just got to be really flexible how you manage your career. And that's what I'd say. I still think financial services is a really interesting sector to work in. I've never been bored, and that's important. As you spend a lot of your time, but you spend more time at work than you do with your family. So it's good to work with. I've got to be careful what I say here. It's good to work with nice people if you can meet them. But the main thing is that you get really interesting work to do, and you develop your skills, and you need to be quite hard on yourself in terms of if you're not learning and growing, make sure you can get to a place where you can learn and grow, because things will always change.
Well, John, I can't thank you enough. This has been a fabulous risk lecture as part of our risk lecture series. The combination of personal experience and insight, but also so much lifelong learning that you've engaged in is perfect for our students, both in terms of content and as a role model. So thank you so much for taking the time to join us this evening.
Well, it's very kind of you to ask me. And I said, if there are any other questions or emails or book lists or stuff, then I can follow up. And I look forward to further opportunities to interact and work with you, Eric, and the team. And thank you for having me again.
Oh, no, terrific. Thank you. And thank you all. You've been a terrific audience. I'm sorry we don't get to see you in person, and I hope we fix that soon.
Yeah, I hope to get to Bologna myself. There's a lot of good things I've heard about Bologna, so I'm really looking forward to it one day.
Terrific.
Thank you. Goodbye.
Bye, everyone.